So let's get some comment and analysis now from Maryam Bhandari, Head of Emerging Market Analysis at Lombard Street Research. Thank you so much for coming in to speak to us. So, as we were hearing there, the fastest economic expansion in 2.5 years for India. I mean, does this perhaps present more of a challenge to Indian policymakers at the moment?
Well, your point is interesting, because while it is true that the four-quarter growth rate or the year-on-year growth rate hit a multi-year or two-year high at 8.8%, this number actually masks a fall between quarters in GDP. GDP actually fell by 4% between the first and second quarters. And what really worries us in this GDP data is the personal consumer spending, which is, of course, the pillar of Indian growth and has fallen for two consecutive quarters. Now, I think you rightly raised the issue of inflation, but I think the aspect that needs to be paid attention to is that inflation is rising at double-digit rates, and real interest rates are heavily negative, between 5 and 8% negative. And the central bank has fallen very badly behind the curve. I mean, you say that wages are rising at 10%, but inflation is rising at 14%. So your real incomes are falling irrespective.
Maya, with that in mind, how much of a threat is inflation to growth in India?
A major threat, I think. I don't think it would be unexpected or surprising if we did see a bout of Indian-style stagflation in the next 12 months, which we have to be precise in defining this, because this is India, not the US or Japan. What I mean is 5.5%, 6% growth with double-digit inflation. In fact, I think today's GDP numbers actually make me a bit more worried about that, because of what we've seen with the spending numbers. Because private consumer, India is very much a domestic demand-driven economy. As we saw, it didn't suffer much in the latest financial crisis. GDP fell only just in one quarter.
It's interesting, isn't it? Because its economy does appear to be more balanced in terms of exports and consumer spending than, say, the likes of China.
Absolutely. In fact, I would have argued before this crisis that India was one of the best-placed economies to weather the crisis. But I think the combination of ultra-loose monetary and fiscal policies that have ended up that way, largely because we had India had an unfortunately timed national election in May, and policy was eased unnecessarily and excessively, has meant that this massive inflation spike was coming. You can only operate at a certain speed limit. So now we're seeing a
bit of a turnaround in consumer spending. You're saying that it's actually falling between the two quarters.
Yes, I'm saying that it's falling between the two quarters, and the central bank is tightening policy at precisely the worst point in the economic cycle.
So does that mean that we could see an interest rate hike soon?
Well, I think the RBI is very clearly signal that it will raise interest rates more, but whether it's enough and comes in time is a different point. I think monetary policy decisions only really impact the real economy 12 to 18 months ahead. So an interest rate move today is only going to do anything in 18 months' time. And in the interim, you have high inflation eating into consumer spending and really threatening the key strength of the Indian economy.
And the expansion, perhaps overheating in India, that we talk about stands in stark contrast to the situation in Japan right now. I mean, will recent measures taken by the government and the central bank to boost growth, I mean, be effective, given that the yen has continued its rise?
We see, I mean, Japan, absolutely. I mean, we had similar second quarter numbers for Japan, and it barely grew. But I think the first point to make is an expensive yen, or yen at current levels, there's two things to Japan. The first is it threatens its export-driven growth model, because exports really are the key to Japanese growth. And the second is it intensifies deflation, which is a major problem both for Japan and the BOJ. But I think the discussion about the yen almost misses the broader point, which is Japan has become excessively reliant on exports for growth, and that really is its Achilles heel. Japan needs to move towards a more balanced growth model. And as we saw in the last 2 years, when you rely on exports for all growth, you end up suffering quite a lot when global demand comes back, as it did.
Maryam Bhandari, Head of Emerging Market Analysis for Lombard Street Research, thank you so much for your thoughts, for putting all that into perspective for us.